Good afternoon, everybody, and welcome to the Weekly Think Tank for Monday, December 7. My name is Carl Capoligua. I'm the market analyst over here at ThinkMarkets, and it is a pleasure to be with you as we kick off what will no doubt be another very interesting, very exciting week on markets. All of that after we talk about the ThinkMarkets Difference, which is substantial $8 flat rate trades, your own holder identification number, and unlimited phone support. 3 reasons why you should choose ThinkMarkets for your next ASX share trade. The agenda for today is to have a look at all the key market moves for last week, what's going on in the world with regards to the economy, COVID. We'll bring it closer to home, have a look at some broker moves, have a look at where the value is in the Australian market, have a look at some charts, and then we'll wrap up by having a look to the week ahead. What a week it was for materials stocks, up 5.26% for the XMJ. Now that includes stocks like Fortescue, BHP, Rio Tinto, Oz Minerals, Mincor, etc., etc., etc. Fantastic performance. In fact, many of those stocks up double-digit gains. Unfortunately for the healthcare sector, they went the other direction by about 2.4%. And the reason for this, and you might think, well, why? What has the materials sector got to do with the healthcare sector? Well, it's more about the Australian dollar. So material stocks going up on rather large gains in the iron ore price. That was up 14% for the week. Copper prices were through the roof as well, and some of the other base metals as well. Energy prices also stronger. And those increases are helping the Australian dollar. So the Australian dollar topping out around about 74.4 cents US, and that's its highest level it's been in a couple of years. The drivers, great for materials stocks, not great for healthcare stocks, because a stronger Australian dollar, you look at companies like CSL, Cochlear, ResMed, Ramsay Healthcare, they've got a large proportion of their earnings in US dollars. So when you go to translate those US dollars back into Australian dollars and the Australian dollar is higher, you're getting fewer Australian dollars bought for those US dollars, and that has a negative impact on their earnings. Now, it does also have a drag on the earnings of those material stocks as well. So BHP, when it translates its profit back to Australian dollars, there will be a negative impact there. But of course, at least they're getting the benefit of those higher commodity prices. Whereas healthcare, it's all downside, unfortunately. Otherwise, look, a pretty quiet week for the Australian market, up a little or down a little across those sectors. Having a look at the market overall, looks very constructive from a technical standpoint. I do note that for the first time in a very long time, we are seeing a long-term uptrend. You'd have to go back to here. Now, that's March 2019 was the last time it turned up, and the last time it was up at all was sort of pre-pandemic, or as the pandemic was hitting us. So great to see that turn up. The short-term trend is still very much intact for this week. That's supportive, and the price action is showing higher peaks and higher troughs, and that's also very supportive. Looking to upside targets, well, 67.14. Obviously, we're having a very close look at that level today. And then there's a small level coming in from here at 68.97. And then not a lot holding us down to 61.97. So overall, I think we're about 8.2%. We'd have to go up 8.2% to get to this level. And not out of the question, given November's strong gain, double-digit gain in November. Can we see this maybe over December, January, because seasonally that's a pretty strong time for the Australian market, really for markets globally. Certainly pretty strong at the moment for the Shanghai Composite. That's a very, very strong looking chart. And I think last week I gave you some Australian-based ETFs you can play. So VGE is definitely one, IZZ is one, and ASIA is the other. I'm getting those off the top of my head, but I'm pretty sure that's what they are. Nikkei also doing pretty well, Hang Seng off slightly. In the US, it was good to see US stocks perform quite strongly. These markets, Dow Jones, S&P 500 and the NASDAQ, all making record highs last week, and it was good in particular to see the NASDAQ do quite well. It's a very risk-on sort of market, so that's telling you global risk appetite is increasing. And previously the NASDAQ had suffered, wait a second, it'll come up on the next slide. Look, FTSE up, some good news on Brexit, otherwise Europe square. Let's keep going with that arrow. There we go. So it's really good to see the NASDAQ rising on the back of this quite a sharp increase in long bond yields in the US. So 13 basis points. Now think about what the Reserve Bank did back in November. It cut rates by 10 basis points. So we've had a bigger than what the Reserve Bank cut last week increase in our long-term bond yields, so undoing all of the Reserve Bank's work. Now, this is definitely going to play on the minds of investors. It's going to play on the minds of central bankers. They don't want to see these rates going up until the economic recovery is really entrenched and jobs are really starting to grow again. So we're getting pretty close to 1% as a yield. It doesn't sound like much, but within the context of where yields have been over the last few years, it is starting to get uncomfortably high. So it'll be interesting to see how markets and central bankers respond to that. We did talk about that, so we'll go back to this slide here. And the reason for it, I mean, all of these slides tie together, don't they? And of course, that's how macroeconomics work. Rising commodity prices, steel up 13%, iron ore up 14%, copper up 3%. Energy, we'll get to the next slide here, up 1% for the week, but huge surge for the month. All very supportive of the market looking forward to growth down the track, but also because of rising prices, inflation down the track as well. And markets, stock markets eventually will probably react negatively to this. But look, in the meantime, the trends are up. Noting here the Australian dollar up 0.5% as the US dollar really got hit quite sharply. And that did help. We'll go back to the last slide, gold and silver. I know we're bouncing around a little bit on the slides, but this week in particular, we have seen how connected these markets are. And apologies there for the little drawing tool taking a bit long to respond. I'm probably going a bit fast for good old PowerPoint at the moment. Okay, this is just a little bit of fun. We have a look at the current crisis, which is this one. So this is now versus the GFC. That's the orange one. And wow, uncannily similar in terms of how this is playing out. I mean, it would put us significantly higher in a couple of years' time. But, plenty of upside for another 6 months potentially based upon that. Anyway, we'll just keep an eye on how that's tracking along. COVID cases, having a look at how they are tracking along, and we've got data for the 5th. It's a little bit in arrears, isn't it? But giving you the idea of the trends. So heading up to about 200,000 cases in the US. They did get over that on Sunday. And the problem, of course, is Thanksgiving. It was starting to come down. We have Thanksgiving. Americans get together. They don't like to wear masks. They don't like to, be told what to do. They give each other COVID, and now we're seeing cases spike back up again. Fortunately, in Europe, things are coming down. Australia and China are still very quiet, which is a good thing. Cases are on the rise in Japan. Let's have a look at the macroeconomic data for the last week. The Reserve Bank of Australia, quite widely, as expected, kept rates on hold. Markets weren't expecting them to do another rate cut. So that was largely taken within the market's stride. What was interesting was to see how many bonds they bought. They bought $19 billion worth of bonds. They, of course, part of the November announcement was a quantitative easing package where they'd start to buy those longer-term bonds in an attempt to drive those yields down. It hasn't worked yet. So Reserve Bank will have to get on top of that if they want to keep long-term rates lower. They did say that there was some economic growth they were seeing, but still a long, long way to go on the unemployment front, and they would continue to support the economy, continue to buy bonds, and they can't see interest rates going up in Australia for the next, quote-unquote, 3 years or so. Having a look at why we're in this quandary at the moment, where we can see there we've got this huge fall in GDP. That is a technical recession, so that's the March and June quarters. During the week, we saw data showing that we did get a bounce back in the September quarter, up 3.3%, but we're still down net 3.8% for the year, so a long way to go. Have a look at some of the data coming out of China. This is obviously helping those commodity prices. We're seeing continued strong data on the manufacturing side of things, but also on the services side of things as well, as that economy continues to shake off those pandemic effects. So you can have a look at the finer details there, but some nice numbers coming through. Not so nice numbers coming through on the US economy. So we have had the V-shapes, but generally ticking lower now, and that is that big impact of COVID, unfortunately, for the US economy. So that will weigh on markets' mind. But having said that, when you include this sort of a number here, so 245,000 jobs created for the US economy in November. That compares to the expectation of 410,000 and well down on the previous 610. There is a significant downtrend here. And, regulators We've got, on the fiscal side, on the monetary side, are going to, keep pumping out the stimulus, or at least that's what the market's expecting. And that's why we actually saw markets go up on Friday, despite the bad data during the week, despite this really soft number for jobs growth in the US. We did see the unemployment rate tick down a little bit on that number, but I think more importantly, and on a negative point, the participation rate fell, which is disturbing because that indicates fewer Americans are having enough confidence to go into the workforce. So a pretty soft number. I mean, at the best, this was about 1.3. Actually, no, it's not true. That was 1.3. This was about 3 million off the top of my head. And then now this is testing my ability to retain these numbers. Actually, that's bigger. I don't know. I can't remember that one. I mean, these are months ago. These are months ago. So forgive me for forgetting. Which one did I forget? That one. I don't know what that one is. But you can see we went 3, then 1.3. Can't remember. About 600, and then 245. So you can see exponential deceleration in jobs growth in the US economy. Markets will have to work this out. Slowing economy in the US versus the hopes of further stimulus. Push and pull. Afterpay, bit of push and pull here. They released their November sales numbers, and they were very good, make no mistake, but a few brokers were quite curious as to why they didn't release a month ago their October numbers. And there was no mention about the October numbers in this report. So we've got at least UBS down the bottom here. There's my mouse, and you can see it's struggling to keep up. UBS retained their sell rating and $30 price target. They said it was quite curious. The report created more questions than providing answers. Now, this is the most negative broker for Afterpay, make no mistake. So you can understand why they're trying to alert the market to these issues, because they're so far behind the curve. So anyway, they're going to keep a close eye on any further updates to see if we get some numbers out. Goldman Sachs, they raised their price target though. They said it was a very strong result, particularly in the US. I mean, for the first time, their US operations are providing more revenue than their Australian operations, and the growth rates are out of control over there, helped by the fact that Black Friday and Cyber Monday fell within the same month. Goldman Sachs increased their FY21 estimates by 6.8%. They're monitoring the impact of increasing competition. Of course, if there's money to be made, companies go in and try and fill that void. Morgan Stanley retained their overweight rating and their $120 price target. Looking at what the brokers are saying in general, we've got 3 strong buys, 4 buys, 4 holds, and 1 sell. Guess who the sell is? Mean target prices, about $100. So overall, if you took an average of the brokers' targets, it's about where the price is right now. Upside is 140, low is 30. We know who that is. PE, current PE. Now, this is, I should say not current, it's 1 year forward. So this is the broker's estimates of what the company is going to earn in FY21. Based upon that, we've got a PE of about 835. And then the next year out, it goes to 202. So this is showing the growth in earnings. So if you can quadruple your earnings, you're going to quarter your PE, right? And if you can keep that going, then, a few years down the track, APT is considered cheap. So if you go 10 years down the track, it's dirt cheap. But you've got to understand the risks of execution, of what can happen in the meantime. And that's the leap of faith that investors have to take to justify some of these multiples, and hence why, UBS is a little bit circumspect on the stock. What do I think? Well, look, I think it's in a great long-term uptrend. I can't fault that. The short-term trend is a little concerning for me. So I'm starting to see a definite loss of momentum here. Now, we've had a number of buys on Afterpay. In Think Technical, we started buying it, if I'm not mistaken, around about that high 50 level, and continued to reiterate buys all the way through. I'm a bit more of a hold now than a buy, simply on the fact that it's losing short-term momentum. I'm happy to hold as long as the long-term trend remains in place. But if you're a shorter-term trader, I would be concerned. I'd be concerned about a break through the bottom of this pennant and a break towards that long-term trend zone. So, look, it's a hold, but hold on watch for me. If it breaks through the top of the range, then we're back on again. It looks fantastic. Okay, Treasury wine estate. I won't repeat the news, or I won't give you great analysis on the news, because it's been well publicised in the media. But China has implemented this quasi tariff on Australian exports of wine into the country. How did the brokers respond? Well, quite mixed, actually. We had Citigroup downgrading their rating from buy to sell, and they lowered their price target. But Credit Suisse upgraded their rating from neutral to outperform and raised their price target. So you can see the price target's almost going in the opposite directions. One going down to $8.20 and one going from $8.50 to $11. Jefferies downgraded their rating from buy to hold. They lowered their price target to $8.50. JP Morgan downgraded the company as well, neutral to underweight. Macquarie retained their neutral and their price target. What did they have to say? They said there is an opportunity to pivot to the rest of Asia and the US operations remain solid. Morgan Stanley lowered their price target from 11 to 10, but retained their overweight rating. They said China's punitive moves against the Australian wine industry will negatively impact sales volumes into China, which, about 30% of Treasury wine estates sales were into China. They lowered their price target and retained their rating for now. So on watch negative there. Noted a strong balance sheet, and the company still has options, but the broker's still cautious on the stock. UBS, well, they're the real value investors. Let's see what they say. They have downgraded their rating from buy to neutral, but raised their price target. Very interesting. Increased uncertainty with respect to earnings stability due to the China tariffs. But again, balance sheet is very strong. They have the ability to reposition as well. And noting Treasury wine estates exposure to premium brands. So potentially even with the tariff, potentially Chinese consumers might continue to go for some of those premium brands. Okay, where are we? Well, broker's still broadly positive. However, I will put a little question mark over this because I'm not 100% sure how accurate it is, because sometimes the data provider takes a little while to update, but take it on face value, still pretty positive. Mean targets, we're at 10.55, which is giving a little bit of upside, but not spectacular, really only into this long-term downtrend zone. In terms of PE, it's not looking cheap. It's not looking cheap. Even at these lower prices, it's not 19, 20 anymore. It's half the price. The PE still looks way too high for me. So it speaks to the impact on earnings that we're going to see from some of these moves. What would I need to see to buy this one? Well, we're a long way off because we are respecting the long-term downtrend. I'd need to see Treasury wine estates break above this long-term downtrend, come back, test it, hold, and then move again. And this is where I'd be looking to get involved. We're looking for a price action signal, probably around about $11. But there's so much that needs to happen before we get there. It's not even worth talking about it. Hey, if you want to take a risk and have a punt and say, this is it, this is the buy level, that's fine and up to you. And you will get a better return. But when it gets back to 20, you would have been in $2 before me. But I believe you're taking way more risk than it's worth to capture that $2 because the price can keep going down. I mean, brokers are downgrading for a reason, right? Okay, keep moving. Where is the value? We talked about what's good value, what's not good value. Well, typically we want to see PEs below 20. We're above 20 now on the ASX 200. The only thing going for us, I guess, is that other markets around the world are more expensive than us. So we've got a little bit of an advantage there, but you can see that the spread is closing. So it's kind of catching up a little bit in terms of us versus the rest of the world. Having a look at the sectors, which are the cheapest, we talked about how prospective the materials sector looks right now. We can see not only is the spinning circle of death on screen, hopefully PowerPoint comes back to me. There it is. We've got a PE of about 13.1. It is on the rise because prices are on the rise. And then financials, I think, actually look really good this week as well. So watch out for those financial stocks. First time in a very, very long time, all four of those banking stocks, big four banks, came up as a technical buy. I like ANZ as my favourite in the big four. But outside of that, in the financial services sector, CGF looks very good. MyState looks very good. And if you've been following our Think Technical section, we've got standing by notes on Australian Finance Group, that's AFG ticker code, and Resimac ticker code RMC. And MyState ticker code MYS. There's a standing by on that one. Okay, looking at the technicals now. So this is how the price of each stock in the ASX 300 is tracking against its respective periods moving averages. So we're starting at 5, which is 1 week, and then we're going all the way out to 252 periods on a daily chart, which is about a year. So once you take out weekends and public holidays, you get about 252 periods. So we've got over 2/3 of stocks on the ASX 300, so 300 biggest stocks in Australia, trading above their 1 year trend lines. And that's great. So we're in an uptrend on a 1 year basis, and that's pretty consistent until we get to about 2 months. And then some of the shorter trends, a few stocks pulled back last week. We saw healthcare pulling back and the utilities, and a few stocks pulling back. So that probably hurt the shorter term trends. But overall, the longer term trends are still very much intact. And I take great comfort from that in terms of prices being able to move higher. So I think that's still quite positive, but watching that short end of the curve. Some of the things we'll be watching this week. Actually, this one came out. It was 52.6. Anything over 50 is expansion. So this is just a broad-based survey of businesses and how they're feeling, tracking along. And that was actually pretty good. So that's a tick there for the Australian economy. Tomorrow, we should have a speech from RBA Governor Philip Lowe. That's already happened. I'll report on that in tomorrow's update. ANZ job ads are out. Also, that was 13.9%, and that was well ahead of expectations. So another tick there for the Australian economy. Coming up tomorrow, we'll get the NAB Business Confidence Survey and the Westpac Consumer Sentiment Survey. We'll get some inflation expectations and then the RBA Bulletin towards the end of the week. So some good data on the Australian economy so far. Having a look across the global economies, the major ones at least, pretty quiet week. We do have an ECB press conference, some inflation data there for the US, and then as usual, weekly unemployment claims, but overall a fairly quiet week as we head into the close of the year. Okay, if you'd like any further information on markets, on stocks we've talked about during this presentation, go and check out our market news page. Or you can follow me or the ThinkMarkets handles on Twitter. Coming up on Wednesday, we're going to have a webinar on how to value a stock in our Think Learning series. You need to register for that in the webinars section of the website. It's I think it's the next option under that when you go to the homepage. So definitely check that out. The disclaimer before I leave you says that the content of this presentation is general in nature. You should consider it very carefully before you act upon it. Don't forget, we are an Australian regulated broker. We do have some products that could see you lose more than your deposit. So consider all of these things very carefully. Give us a call or consult the website for further details. Well, that's it for me today. I'll be back with a bunch of other updates throughout the week. Until then, all the best for your trading. Bye-bye for now.